Let's take a look at your market news now. Asian markets dipped today after the dollar took another beating. This came after two of U.S. President Donald Trump's top cabinet members talked down the currency and hinted at a more belligerent trade policy. Earlier, the U.S. announced stinging tariffs on imports of solar panels and large washing machines, angering China and South Korea. In Tokyo, the yen hit a 4-month high against the dollar. This was bad news for Japanese exporters. The Nikkei lost 1.1%. Hong Kong shares suffered only their second loss in 23 days on profit-taking. The Hang Seng Index shed 0.9% and the Shanghai Composite Index declined by 1/3%. On Wall Street yesterday, the S&P 500 and the Nasdaq Composite Index lost ground in choppy trading. This came in the wake of comments by U.S. Commerce Secretary Wilbur Ross, which hinted at action against China in a trade war. The S&P 500 ended flat and the Nasdaq dropped by 0.6%, but the Dow Jones Industrial Average rose by 0.1%. Now for more on the markets, we're going to cross over to Nompumelelo Siziba. She's standing by at the Johannesburg Stock Exchange. Nompumelelo, over to you.
Well, the all-share index is trading in the red currently, with most of the sectors on a downer. Mining counters and financials have registered positively during the session, however. And meanwhile, we see that the local currency has lost a little bit of steam relative to the New York close. It closed at 11.84 against the greenback, but today was sort of hovering between 11.86 and 11.93. So having lost a little bit of ground there. And oil prices surged past the $70 a barrel level, hitting $71. That's a psychological level, so there could be some room for upside if current fundamentals remain. We see a lot of demand for fuel in the United States and generally in the Northern Hemisphere because of very snowy conditions and so on. OPEC oil curbs currently also constricting or restricting supply of oil. And just generally the US oil rigs producing less oil. So those are buoying up the oil price at the moment. And a weaker dollar, the weakest it's been in quite a long time, is generally being good for commodity prices. Let's take a look at the indicators. Well, I'm joined by Maudi Lantswane. He's from Lehuma Capital. Thank you very much for joining us, sir.
Thanks for having me.
Good stuff. After a somewhat bullish run on the markets, global markets seem to be looking rather bearish today. What's happening?
Yeah, look, we have a very good run since the beginning of the year. You know, you're never going to get an uptick on a straight line. You're likely to get days where we come off a bit. But I think all in all, you look at the equity markets in 2018. I mean, we've had a tremendous performance, and this is across the globe. You know, you look at the U.S. markets, the performance they're very good overall. Up just over 6%, the Dow and S&P 500. So a very good performance also in Europe, and of course some positivity that we're seeing also coming towards the emerging market. So all in all, it has been a good start, and I think it's likely to continue with this momentum.
Indeed. And I did mention that the oil price surging through $70 to 71. This is a great thing for the producers, not great for consumers. But what do you think the trajectory is, given the fundamentals that I outlined?
Yeah, look, I think the oil price will remain well anchored in 2018. Couple of things will support the oil price. One is the fact that when you look at across the globe, the global GDP is improving, more revised upwards for 2018. The second other factor is, of course, OPEC members that they've been cutting production. And the speculation is that they might even cut beyond 2018. So those are the factors that will remain very supportive of oil. But of course, the challenge is always the U.S. shale producers who, when the oil price gets to all these attractive levels, they come in and then start pumping more. So it's a matter of how much of demand do we get versus that additional supply that we're likely to get from the shale producers. So depending on which one pushes a lot more, it will determine which direction the oil price goes. So if we have more demand recovery in the global GDP, which I think is likely to happen, then we could actually see the oil price well anchored around these sort of levels.
Globally, everyone is talking about this weaker US dollar. What do you think are the factors behind it? And just relating to the South African rand, we see that it's doing extremely well. Of course, it's an emerging market currency and it would generally firm when the dollar is weaker. But how much of it is the Cyril Ramaphosa effect, do you think? So that's two questions in one.
Yeah, look, the Cyril Ramaphosa has had a positive impact on the rand. But I think there's another factor that you mentioned, the fact that we got to this 11 rand 84 cents, not 100% entirely due to the rand strength, but it is also combined with the fact that the dollar is also weakening on the other side. So the Cyril Ramaphosa is a positive story, and it should remain supportive of the South African economy, and it should also remain supportive of the rand as a result. But the dollar also, that weakness that has come through, has of course resulted in the dollar rand exchange rate coming down to these levels. Whether or not the dollar will remain weak, I think it's a bit of a difficult one to answer. There are a number of things that could happen. We know that the Fed has indicated that they're likely to increase interest rates 3 times this year. If we get an indication that the Fed or inflation rather in the US will begin to pick up at the pace faster than what the Fed had projected, then the whole scenario could change. We could get into a situation where the Fed now becomes more aggressive, and that could push the dollar higher.
And I think that's more when than if, simply because of these tax cuts. I mean, they're huge.
100%.
They're going to inject $1.4 trillion into the US economy. Yep. People are going to be spending money. That's going to push prices up, surely.
Most certainly. I mean, we're likely to see the GDP in America revised upwards due to all those tax cuts. But also the other factor is that the weaker dollar that we're currently having, that could be a self-fulfilling prophecy for the higher inflation. That now you've got a weaker dollar, that would result in imported inflation, and that could actually push the inflation higher.
Now, in terms of the firmer rand, previously when we've talked about a weak rand, we've talked about the importation of inflation, how it's negative and so on and so forth, but it's always been a positive for the local all-share index. Presumably, if it remains sustained at firmer levels, that's going to be bad news for our rand hedges.
Yeah, no, it's true. The stronger rand, it's an indication that we are doing something right, that the investors are positive, optimistic about our economy. So when we have the stronger rand, it's always as a result of the good that we're doing. So as I said, so at this point in time, it's not so much what we've already done, but I think it's what we're likely to do in the future, and which is the sentiment around the ANC elective conference that came out with the positive results, and already we are beginning to see the changes, whether it be the Commission of Inquiry into the state capture, whether it be all the changes that we've seen at ESCOM, and the positive steps that we've been waiting for those steps to be taken for all these years, and they never got implemented. So it's a positive sign, very supportive of the rand, and it's a debate as to which level of the rand would the exporters desire. At some point, your stronger rand begins to be negative for your exporters. The manufacturing sector begins to encounter some problems. Also, the rand hedge stocks begin to also encounter some problems, of course.
Indeed. Well, we've run out of time. More to talk about, but not enough time. Thank you so much. That was Maudile Nswane. He's a portfolio manager at Lehuma Capital. After a short break, Nzinga has more business news for you.